Hello, YouTube. I hope everyone is doing well. On my side, on the charts, I'm doing very, very well, extremely well, I should say. But in real life, it's a bit shaky. The winter season is brutal for my body. I do have a skin condition. All right, so June for me is bad all the way up until September. September, that's when I will feel like I'm human again. But for now, you're gonna bear with me. I will not be posting a lot of videos. July's commentary is going to be a bit different. These are going to be lectures of me explaining what market structure is, in the lens of ICT. Michael Joe Huddleston is my mentor, and we trade ICT. That's the methodology that we use. And I keep on saying in my videos that if you offer methodology that is different, you have a different perspective of the market, how you trade, and all of that, that's all good. I'm not trying to convince you to switch your strategy or do anything with what I'm putting out here. I'm just an educator, and some of the things that I might say might resonate with you if you have the type of personality that I have. This year's commentary is best suited for day trading, specifically intraday market conditions. If you're familiar with that territory, then you're gonna love what I'm producing here in the synthetic community. Well, I trade ICT the way that you would trade it in the real world markets. It sounds sounds crazy, right? But that's true. That's what I do. I look at price action the way that I do when I look at, say, gold or GDP or the dollar index. I look at it like that. So I'm currently trading step index only. That's what I'm focused on. And we had the June mega trade, which I posted about it in the previous month, which is June. Do check that out. It's awesome content, right? I was mainly talking about a swing trading setup that tends to happen. Hence why the title, June mega trade. Okay, I give it all out, man. You need to be wary of the price action that tends to be of a repeating phenomenon in the middle of the year, right? If you look at the previous year commentary, I was a swing trader. And in my discovery that if you're particularly doing a swing trading model, but you are a beginner, that's a wrong way to start, okay? You need repetition. And the daily time frame, if you're only focused on the daily time frame, it's not going to give you everyday setups. It's not going to do that. It's going to take a lot of time for a setup to form. There's a lot that you can do on the lower time frames. For me particularly, I am a scalper, and I believe that if you can transition from the higher time frames and you're transposing it into the lower time frames, and you're treating the 1 minute time frame the way that you would trade the daily time frame. Time here on the markets is fractal. What you can do on the daily time frame, you can also do on the lower time frames. It's a fractal. It happens on the lower time frames and it's repeating. What I'm showing you here on the daily time frame is repeating in the lower time frames a lot of times. Every day it happens. The market does only two things. It trades into inefficiencies and it attacks most obvious liquidity pools. So the most obvious ones were these inefficiencies in December, this run to the downside. That was hella suspicious. There are some things that I want to disclose about market making concepts. So as I said, these are lectures. You need to pay close attention because I will be talking about a lot of things, but I'm going to put it in a structural way so that you can learn faster. Now, how you learn faster with the markets, when you're trying to learn the markets, maybe you're a beginner or an intermediate trader, it doesn't matter, right? What you need to understand first is market structure, how the market behaves. Now, you as a trader, you might relate to this type of price action. We trade ICT. You might be of the same school of thought, and this is easier for you. But there are some people that are new, a brand new beginner. You have no idea what you're doing in the marketplace, right? So if you're that kind of a person, maybe you're coming into this methodology of ICT. By the way, I am not trying to convince you to trade ICT or to trade step index. All right. I'm not enticing you to leave what you're doing, come to this side. The grass is greener on this side. No. All right. You just witnessed the mega trade for the middle of the year, which tends to happen. If you watch the last year's commentary, I spoke about the very same phenomena happening. I came out and I said, hey, here are relative equal lows that were printed in the previous 6 months, and that's where we're going. It's the draw on liquidity. If you watch the June mega trade video, I'm going to show it right up here. That's the one. If you want to understand how you can frame this particular setup and try to attack this particular low, it's the most obvious swing low. All right. So this particular swing low, remember that price action does only two things: liquidity and inefficiency. So how would the market maker deliver price action down to this low? Right? That's the question. How would they do it? They would need a framework. And this is the framework. You're looking at it in your screen right now. Ask any ICT trader that you know. Show them this chart and ask them, what is this? Right off the bat, they will tell you, this is the ICT 2022 YouTube model. Okay? That's what they will tell you. Ask any trader. We are trading the same thing. It doesn't change. All right? The only thing that changes is time. But the pattern that we trade, it's a pattern. If you would look at it like that, well, that's good. But it's not just the pattern. There's a lot more that is going on with what you are seeing here in this chart. So it's one of those lectures where I will talk about market structure. And what I really want to touch on is time. This is the mega trade that happens in the middle of the year. Now, last year's commentary, if you watched the previous year's commentary, I did the same thing. I came out in June and I said, this is where price is going to go, which was to the downside. If you look at a particular video, maybe you want to understand it so much better, all right? Look at the seasoning in a stew video that I did last year. I was cooking. I was in the kitchen. I cooked out the very same thing that you're seeing here on the chart, right? So it's not a big deal, honestly, right? So if you want to understand what you're seeing on the chart, go to that particular video, all right? I highly recommend it. But if you watch that video, you're going to understand that this is a swing trading model. Now, I trade step index. I started trading step index particularly for that particular reason. So many particulars. I started trading step index for that reason. It's a swing trading instrument. It takes longer for the setup to form, but when it forms and it completes, wow, it's beautiful. And the way that it moves, it can be one directional like this for a long time. Imagine that you've shorted the market on this fair value gap that I spoke about, and you're holding your position. I would be happy holding that motherfucker. I don't want to lie, but I am a day trader now. I dive in intraday markets, specifically those tiny sessions that happen in those market hours. So that's what I'm interested in. So I specifically trade this market. It has a swing trading kind of nature, right? So anyone who wants to trade synthetic indices, recommend them to this channel, all right? Anyone who's a beginner, anyone who's trading, just holler at them and say that there's a guy who teaches synthetic indices with ICT's concepts. That's really insane, right? But you gotta find an instrument here in the riff. Let me show you the riff. What is it all about? But the market that I resonate with is step index. So let's step out a little bit and go to this particular website. It's from the riff, right? And up here you can open an account and you can try a demo for free. So here's the title, Trade Synthetic Indices. Now, what are synthetic indices and why trade synthetic indices with deriv? You know that we have a 24/7 trading. It never sleeps. It just keeps on going 24/7, right? It's free from real world risks and it's got pretty interesting leverage, right? They offer crash and boom, volatility indices, hybrid indices, volatility switch. They keep on adding, and I'm not interested in anything but the step index. Now, the step index that I trade is called step index 100. They've added five more, I think, and they've added different kinds of stuff. So, what is the step index? You would need to learn about it here. But essentially, what step index is, or what derivative indices, synthetic indices, what they really are, is markets that are trying to mimic how the real world moves. But there's a twist to it. These instruments, they move at a particular time, right? There's a time where liquidity is vaporized. There's a time where it is attacked ruthlessly. And you want to be in those type of trades. And I just spoke about it. It's the June mega trade. You can just come out here in June and take out those types of setups, man. So that's what I'm about. That's what I'm about here. I'm trading step index. This is the market. It's pretty interesting. So I skipped out the previous 6 months price action. There's a particular characteristic that is associated with this type of price action, and it is consolidative. It is highly resistant. It doesn't move nicely. Okay, your bank balance is going to be trouble if you try and trade this market condition while it is consolidating. So why the 6 months gap? And you left us with this choppiest price action. Sorry about that, man. What really happens when price moves quickly? If you look at the previous year's commentary, I talk about it. When price moves quickly, well, what tends to happen or what tends to follow is a market that is consolidative. It needs to rebalance whatever inefficiency that it left in December's price action. It needs to be rebalanced. That's market efficiency, right? It's efficient if it delivers into those inefficiencies. How else are we going to take these type of trades if price action does not trade back into those inefficiencies and offers a trade? Because majority of us would never ever sell short above a swing high. We are afraid to do it. Imagine you're selling price action up here with all of this bullish run ramming through December's high, and you're going short. That would be awesome. But majority of us don't have that type of experience. So we don't trade turtle soups. That's what it is up here. It is ICT's terminology, which means that liquidity was taken. And was taken needs to be studied. How did price get up here? Why does it need to take up this particular high? There is liquidity above this high. Well, we are taught in those books that put your stop loss above a high, right? So what happened here? Your stop loss was taken. Just like that, right? It's in the books. Okay, I'm not saying nonsense up here. It's something that is in the books. You are taught, if you're a beginner, that you put your stop loss above a high, right? So that's you up here. That's liquidity. Majority of us up here, because we are taught to trade support and resistance. Resistance does not work majority of the time. Otherwise, we would be rich, right? But what you're looking at is a market efficiency paradigm. You don't know what that is because you're new, right? You're new to trading or even to the ICT community. Well, what that means is that market has to deliver in a certain way. It has to deliver efficiently and very precise. If it's not precise, then I'm not trading. I am not trading. If I'm not seeing clear structure where price is telling me that it wants to go a certain way, if I'm not seeing that algorithmically, look at this high in that consequent enroachment. That's beautiful. Algorithmic signatures. If I'm not seeing that, then that market is not delivering into this fair value gap to offer me a setup. It delivers into that fair value gap to re-deliver and rebalance that inefficiency. Now, you may not understand what I just said, but let's take it through the lens of a high, right? What's up there, as I've explained, it's liquidity. Down here as well is liquidity. So many people would look at it in a resistance and a support. Well, they are not wrong, but that is not the whole truth as to what happens into the marketplace. That's not the whole truth, buddy. Okay? You need to learn that there is a market efficiency paradigm that offers market makers a, well, I could say, an easy way to run the markets. Well, you sell short above stop losses and you buy long below an old low, right? You hear a lot of guys or a lot of floor traders, they tend to say that. That means that a total soup is happening. A total soup is price action coming back into an old high to take out liquidity, to absorb everyone who would be trying to buy a breakout, right? Some people are seeing this as a market structure shift and they want to see the market continue in that direction. Well, they don't understand what happens in the middle of the year in STAP index. Now, I'm not running a private show, behind a paywall for you to understand what just happened here on STAP index. Okay? I'm giving this knowledge for free because I believe that knowledge should be free. Right? Unless I need some cash, maybe I'll open a mentorship. I'm kidding. I don't need that. All right? I don't need that. I'm just showing you what price action is doing in my own free time because I love this. I breathe this. So I need to talk about it because majority of the people that I know that are traders, well, they don't trade ICT. I realize that ICT is the minority of traders. And yeah, we make the most money because we go against everybody else. Right? We went against all of the support and resistance traders here. Right? And the trend line phantom guys here. I mean, they made money in the previous 6 months. As you can see, this trend was going to the upside. Maybe if you incorporate this diagonal support and this structure here, this is the reason why I don't trade support and resistance, because your key level, you're not sure yourself that where is the key level precisely. Is it from here to here? Or from here? Or is it a zone? I don't talk zones. You never hear me talk about that. I talk precision. ICT has precision. I spoke about this price trading into the consequent enroachment of that inefficiency. That is efficient. Market efficiency paradigm. That's it right here. Market is delivering into a fair value gap, but it's not allowed to go above the 50%. Of course, the wicks, they may trade above that particular consequent enroachment. Color outside the lines, take some orders above the consequent enroachment just a little bit, but respect the 50% of that inefficiency. That's really interesting, man. That's really, really interesting that there is precision in that inefficiency rather than looking at key levels, right? This key level has 3 levels. You have the fair value gap high, the fair value gap consequent enroachment, and the fair value gap low. 3 levels. There's one particular level that price action should respect if we have a certain bias. That's an algorithmic price signature right there. If price action traded into this inefficiency but did not respect the 50%, that would be alarming for my bias, right? So I can change bias based off of these key levels. These 3 key levels. They give me what I want. And that is support and resistance. True support and resistance. This is what it is. I showed you another form of support and resistance with price gradients. So looking at that swing high down to that swing low, the 25% is down here. And if you look at the 25%, we had some support into that particular key level. And the 50% as well. Resistance with the 75%. And the 50% being the equilibrium of this dealing range, high and low. So there are price gradients that you can do with a dealing range. And there are price gradients that you can also do with fair value gaps. Every PD array, you can apply price gradients. And that is your support and resistance. I just shortened your learning curve if you're trying to understand ICT concepts. Every PD array, a wick, just like this one, it has some sensitivity in the 50%. What? You don't believe me? Let's hop into it. Let's zoom in a little bit. Let me show you. All right. So price gradients, that is our support and resistance. If you're trying to understand support and resistance with ICT, you need to be familiar with the Fibonacci retracement. Right? So we take the close of this candlestick and we take it to the low. And let me edit these price out. It's 0.5%. It's in there. Aha, got it. So look at the reaction from yesterday's price action. It hit the 50% of that particular wick. Right there. Chef's kiss. And we are gone. Right? So we need to be familiar with the price gradients. Each and every PD array, you can apply price gradients. So we're going to see the sensitivity of the 50%. And I'm going to explain to you something that is really advanced. All right. Those wicks that you see on the daily time frames, in the 50%, a fair value gap in the lower time frames. You may not understand it as of yet, but just know that wicks are inefficiencies. Repeat, wicks are inefficiencies. For me, personally, wicks take precedence of every other PD array because it's an inefficiency. It's a daily inefficiency. You're taking it from the higher time frame or even in lower time frames, the very same view can be perceived because price is fractal. Whatever that I just explained with this particular wick, the January wick, well, it can be utilized. The very same principle can be applied on the lower time frames. So let me delete that Wait, let me get the 50%. I need the 50% of this particular wick because it's going to be salient with today's price action lecture, which is about market efficiency paradigm. So price needs to deliver efficiently, and it needs to go with rules. Price should respect the key level in the middle. Remember, ICT has 3 levels. This one is the wick high, the wick consequent enroachment, and the wick low. So I'm going to take the Fibonacci off because I got the 50%. So this needs to change into a dashed line because it's a 50%. It's the consequent enroachment of that daily wick, right? So let's zoom in. So we're back here, zooming out a little bit. So what you can take from this particular video is that when you are trading your model, any low that you are attacking on the downside, price may not get down there. So you need to utilize precision trading concepts like the consequent enroachment of this particular wick, because sometimes it may not get down to that particular low. Now, if it does not close below that consequent enroachment, for me, it is bullish. If it does not close below that and it keeps on going higher and higher, I'm going to be bullish for a while. Well, price needs to respect that, and it had done that beautifully in yesterday's price action. It takes years for you to understand this kind of stuff. This is where it started. It moved quickly, right? So when it comes down, it will take a moment to pause and rebalance. Well, I think what happens is that those long positions that were accumulated down here, they took some off here above this high, but obviously they couldn't get all of those positions out. So they need time to take out those positions off and reverse, go the other direction. That's the market efficiency paradigm. Where are they taking profit if they accumulate short positions in the green fair value consequent enrichment? Key levels. We're talking about key levels here, not a zone, man. Get out of here. Get out of here, bro. So that's our key level. Market structure permits us to trade into this particular fair value gap and anticipate our ICT 2022 YouTube model on a daily time frame. You can swing traders, but unfortunately, I'm not a swing trader. I am a day trader, scalper, intraday price action. That's where I'm at, right? So we had this particular fair value gap consequent enroachment offering us an opportunity. That's not the only setup that I am seeing on this chart. There's another fair value gap that I spoke about with June's commentary. I spoke about this fair value gap occurring when price does a market structure. It needs to go back into that inefficiency and rebalance. Then that's when we can take another selling opportunity. But it moved quickly, hey? And it happens. It happens. We miss those kind of trades. This is the kind of trades that I'm interested in, not this high resistance. So this is high resistance, liquidity runs, and here is low resistance, liquidity runs. So each and every single day, I can participate with a bearish tone in the marketplace. I have a bearish bias. Each and every day, I can go in and out of the marketplace with a big lot size to the downside. I'm kidding on that one. But yeah, every day. How many up candles did we have from this fair value gap down to this consequent enroachment? We only had one. This is when we would have lost a trade trying to go short. Only one trade. Only one day we had a bullish candlestick, but the majority of the time it was bearish. So price action did not take long for it to get down here. Comparing it from the previous 6 months, it took just 6 months just to take out that particular high. So what was happening? It was rebalancing. You may not understand what I just said, but stick with me for a while and let me show you on the lower time frames what you can do with markets that are moving in a certain way. Let me show you on the lower time frames. There's our swing trading model, but we're going to transpose it into the 1 minute time frame. Now I'm going to explain the very same market efficiency paradigm, but in a lower time frame. The higher time frame model transposed into the intraday. So let me first talk about today's price action. I just want to illustrate some things in the lower time frame. So I'm putting out the session breaks, and this is today's price action. It is bullish. We had this key level on the daily time frame support. Remember that key level? It is the daily time frame consequent enroachment. It's that wick. John Wick is in the building. Okay? And he's the middleman. He's the middleman down here, supporting price and going into the upside. So since we've supported on that daily time frame wick consequent enroachment, we want to be seeing markets that want to go up. Price is not allowed to trade below this key level. That means it can only go up. So you have a bullish bias from now on. Where are we trying to get to? Well, we have the PM session right here, that 4 o'clock hour. That is still salient today. That is Wednesday's price action. That's the high that we had for the PM session. And I'm going to take it up to here. We have this high relative to this particular high. That is a key level that we need to attack. So if I know that there is relative equal highs up there, and I know the price action has supported on the daily wick consequent enroachment, what I need to do is wait for the session that I trade. If you're available for the London session, here's what you can do with the London session. If you have a bias, come in London session, and these are the times that you should be sitting down with no distractions. You're coming into the charts in the London session. So where do you start? The PM session. We've already identified possible targets, liquidity pools from the previous day. How to trade the London session. So let's zoom in. You know me, I like to zoom in. So at 130 has an inefficiency, as we can see. Now our inefficiency, we want to see, does price action has a willingness to move away from this inefficiency. So how does price action perform during the London session? Right? It trades into it, tries to go down here, sweeps out that low, but does not close below that low. What does that tell you? Price action is bullish. This is a bullish signature. It's an algorithmic price signature. It is bullish. We don't want to use this inefficiency to go down yet, right? So it goes up above that inefficiency, and we can trade it as a support. So this is a long that you can use to attack these buy-side liquidity pools. But this trade setup would be short-lived. As you can see, price action went lower into the particular low here. That's quite interesting, right? And we really tried to go up once more time, but we failed. So somewhere here, maybe we could have taken a loss, and that is fine, right? That is fine. So Initially for London session, it went lower. How I teach the London session model is that price action should use the inefficiency for London session opening range. You can utilize it to go long. Maybe you try to go with it long today and had a beautiful setup above that high, taking profit above that high or at that particular high. That would be awesome. But after that, that inefficiency was not respected. Okay, so that's interesting. That's really interesting to me. But otherwise, it went lower. We came back down into those lows. We took out some liquidity pools. And then we reversed and we went all up. So price action was in a consolidation type of manner in the beginning, right? But after that, we had the New York session open, which was right here. By the way, up here, we had the 5 a.m. You guys know 5 a.m. is the London session lunch. So we had the London lunch, and that's the 5 a.m. It drops slower all the way down into this particular low. Does it take out that low? We are not sure. Okay, it does. It does take out that low, and they are accumulating those long positions down below here. The initial low of London, that's the low that they are using to accumulate. So they dropped down the market rapidly, and shortly after a few minutes, we had the New York session opening range. So here's the 7 a.m. and we're gonna zoom in into that 7 a.m. and see if we can have our inefficiency. So London session was difficult to trade, honestly, right? It was difficult to trade. So the New York session, let's see what it provides. We had this inefficiency right here. Since the beginning of the New York session, opening range, 7 a.m. to 7:30, we don't have an inefficiency up until here. So we're gonna take that inefficiency right there and here, right? So down here, what is that? Remember, we just took the London session lows and we went up. We left this inefficiency. What is that? That is a breakaway gap. What are we breaking away from? This London session low. Let me unzoom a little bit. Right, unzoom, see where we at. So we took out the London session low. We are remaining with the 5 a.m. London lunch market efficiency paradigm. We take out the lows, they accumulate down here. And when they accumulate, there is the algorithmic price signature that they are using to accumulate those long positions. It's respecting that London low, kind of like a double bottom, but it's not a double bottom. We are looking at the candlesticks, how they form into that particular low. Even though it takes out the liquidity pool, it still respects that low. So it creates a fake move to the downside. That's a failure swing. It leaves this inefficiency. That is good. The first algorithmic price signature that we are able to see clearly is the London low being swept, but the candlestick bodies are still respecting that London low. That is one. Number two is the breakaway gap. Anytime you see breakaway gaps and you anticipate the market to go up and you're seeing this inefficiency remain open like this, that is beautiful. So here is our inefficiency. Price trades into that inefficiency and it comes back into it one more time, right? Remember, we have a 3-point of a stop loss. We utilize the 3-point of a stop loss. So price action coming down here is just making sure that everybody is on board. The train is about to leave, right? There is another PD array that you can formulate within this particular trading session. You can integrate another PD array that is close by. Close proximity PD arrays that are near the opening range, that is really helpful. Okay, you need to find these converging PD arrays that are nested with that New York opening range fair value gap. What is that PD array? Oh man, you guys have a long way to go. It is that particular wick. So this wick, we take it from the high down to the low. We respect the quadrant levels, right? So the quadrant levels, they offer support and resistance. So initially, when we were entering our position in this New York session, opening range, fair value gap, the 50% of that wick is supporting the narrative that it is respecting the 50%. Down here is coming back down to do what? Remember, this is a wick. This wick needs to be efficiently traded back to. So sometimes they may come into that wick just to 50% and go up. But sometimes, which today was an exception, it came back all the way down to touch that wick low. So you need to be familiar with what is near this particular fair value gap. Sometimes it may be another inefficiency, right? And inefficiency is easier to trade. But sometimes that inefficiency is masked by this particular wick. So you peel that wick into half and you have the 50%. So that was beautiful. The New York session, right? Beautiful. Absolute beautiful. So we go up and up and up forever and ever. Amen. Where are we going? That London lunch high. We attack that London lunch high and look at this. Around this particular time, that was the 9 o'clock hour, it takes out that buy side liquidity and it starts to trade back. Now, if you recall, this is the London fair value gap. The reason why I did not take out the London fair value gap, it should be in green color, because green colors, we associate that with London. And New York session, we associate that with orange. So we come back into the London fair value gap. And what are these that are being printed in the London fair value gap? 10 a.m. lows. 10 a.m. lows were taken out. Beautiful, magnificent, right? So up here, what are those? 10 a.m. highs and 10 a.m. lows, right? They utilize a fair value gap to accumulate below the 10 a.m. lows. 10 a.m. lows is nested with that London session fair value gap. Now, smart money is looking at that and saying, well, we have these guys down here, the 10 a.m. guys. We take them out and we reverse the market to the upside. Where is the target that they would need to offload those positions? Up here, market efficiency paradigm. So here in this hour, what is that hour? 11 a.m. New York lunch went beautifully to the upside, man. It was beautiful. Well, we had the PM session. Well, since I'm giving you the entire daily range, here is the PM session for today. So anytime that I drop a video, obviously I'm gonna somehow do a daily range, because this is an intraday model. The setup can occur in London, in New York, in PM. I have many trading opportunities. If I miss one trade setup, I won't cry about it, because this thing is repeating in nature. So here is the PM session 130, right? So it says 129, 130 is right here. Do we have an inefficiency? No. We have a volume imbalance. Now, I'm not interested in volume imbalances. What I am interested in is fair value gaps. So we need to look at the first inefficiency that forms, which is right here. So here is the first inefficiency that forms, and as you can see, that inefficiency is not being respected that much. As you can see, we are dilly-dallying and trading above it, trading below it, trading above it, trading below it. It's not really giving you a clear structure as what it wants to do with that inefficiency. Now, as soon as I see that, it just takes me about 30 minutes or to an hour just observing price action. And if I'm observing something like this, then I step out of the marketplace and leave, because I'm not trying to trade in this consolidation. I'm not interested in that type of price action. The type of price action that I'm interested in is this type of price action, man. This is the one. This is the one. If I see price action behaving like this, man, I'm all over it. All over it. So I'm going to be bullish for a while. That is my bias. I don't know even why am I giving you my bias. But yeah, I am bullish for the time being. I'll let you know if anything changes with my bias. But I'm going to be giving you a lot in July's commentary. So I know it's going to be a lot. So take it in one video at a time. So until the next video, goodbye.